And so today we begin with our further discussion on options. So we started with some preliminary discussion the last time. So and a recap of a few things pertaining to math finance, which will come handy. So did we get a chance to quickly revise a few options concepts as well? So did we do that the last time, or was it generally talking about distributions and maybe correlation, covariance, etc.? So did we talk about European, American options, etc., or not yet?
No, sir, not yet.
Okay, okay. So we can do a quick recap. So for some of you, you will be aware of it. For others, where I mean the that subject might not have been covered. That topic we'll quickly get a recap of that. So maybe I'll stay on the whiteboard for the moment, so that, or maybe let me see if I have a small presentation on options which we can quickly use. So if I know or if I recollect, financial economics has something on options, right, as a part of the earlier subject, but the international business class doesn't have options. Am I right?
Yes, sir. You have taught us the options concept, sir.
Oh, okay, okay. So maybe I mean a few things will be a recap for you guys. For others, for the other section, for which I mean, since they don't have this thing as a part of the curriculum, we can do a quick revision. So let me just look up a simpler PPT. So for the other class, and are you guys familiar with what options is, at least briefly, or was it not covered at all? So the international business class. So do you have anyone from international business here?
Yes, sir. We have covered briefly the concept of options, but not in complete sense.
Okay, 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 okay. So maybe a quick recap would be helpful. And for the rest also, I mean, it will be like a recap. And for those of you who have not seen options before, it will be like a quick revision, I would say. Because once we just do a quick recap, it will be useful to talk a bit about binomials and other models which we have. Okay, all right. So yeah, so let me just start this new presentation and discuss. I'll just reshare screen. So starting with the basic, I mean, what is the definition for an option? So, and the definition I've mentioned here, so you can read through that. But the idea of this is we have two parties. One is a buyer and another is a seller. So buyer has the right but no obligation. So assuming that you are a purchaser of option, you will have the right but there is no obligation to exercise the option. So uh, so buyer has these two things, but for a seller, it's only an obligation. For seller, they can't say no. So in case the buyer decides to exercise the option, they have to say yes, and that way, I mean, that transaction goes through. Then buyer is also called as the holder of the option. So you can find these words being used synonymously in many books or literatures. Whereas seller is called as either a seller or a writer. Both mean the same thing. Then option writer or seller, they are taking a risk when they're selling an option. So for that, they have to be compensated because no one will take risk just like that. So since they're selling this right to the option buyer, they have to be paid for taking that risk, and that payment is the premium payment. And this happens upfront. So when you purchase option from someone, this premium exchange has to happen at the outset of the contract, and that is that. So then, depending on what nature of the option is, the payoff will change. But premium is like an initial cost which has to be paid. Then we have two varieties: call and a put option. So from a buyer's perspective, what would a call option imply, and how what would a put option imply? So imagine
So
your
call
option
option
buyer.
is the right to purchase, a right to
Correct.
purchase at a preset price, and the put
Correct.
is a right to sell a particular script.
Correct. So one is a right to buy, other is a right to sell. Correct. So that's what we call as a call and a put option. Then options market is it's a very large market, so that way you'll find options which transact on exchanges as well as in the OTC market. Of course, the OTC market is far bigger as compared to
Excuse
exchanges.
me, sir.
Yes.
Sir, I'm sorry, I'm not very clear with the call and put rights. Can you explain it
Okay.
again?
Okay. Yeah. So let me give a simple example. So uh, let's say I'm party A and there is some seller party B. And imagine that I want to purchase a certain asset, but I don't want to purchase it right now. So let's say B is some manufacturer who is preparing or who is preparing or producing a certain product which I want to purchase at a later point in time, and I want to purchase it at a time point of 1 month. So starting today, I want to purchase it after 1 month. I'm interested, but not at the moment. And I'm comfortable with paying a price of 100 rupees for this asset. So maybe some asset X, I mean, take any asset. So this is what I have in mind. So what I do is I approach B and I tell them that I really like your product, but at the moment I don't want to immediately purchase it. But after 1 month, I would be interested in buying it. So can we enter into some contract whereby I can lock in the price today? So I'm comfortable with paying 100. Anything beyond 100, I don't have the money to pay that. So 100 is all that I can pay. So that way, you're trying to remove any kind of uncertainty in the price of that particular asset. So that way, you approach B and you tell him that, fine, let's enter into the contract. And if B agrees, you sign on a piece of paper today, you pay a certain premium to B, and you purchase the option. So that way, you're buying a certain asset. Let's say X is your asset, and you want to buy that. So effectively, what you have done is you have purchased a call option. So it's a buy call for you. So imagine that we are party A. So for us, it is a buy call position. So let's start to see how this is going to behave. We have, let's say, a scenario one and a scenario two. And these are the scenarios at 1 month time point. So on 1 month, imagine that we end up in either S1 or S2. S1 is a scenario whereby the stock price goes to, let's say, 150. And in S2, let's say the stock price ends up at 50. It can be either one. We don't know which one. So I have entered into the contract. That is it. I mean, I just sign on the piece of paper. It's a plain transaction, which I do. We don't exchange any assets at the moment. I just pay a premium and that is it. Now, let's say I am at the 1 month time point and imagine that we end up at S1. So if I end up at S1, would it be beneficial for me to exercise the call option? So those of you who have already studied options, request you to hold on. So for the international business class who have studied options briefly, I would request someone from their class to attempt this. So in scenario one, would it be beneficial for me to exercise the option or no? My agreed price is 100. The current market price for the asset is 150. So would I exercise or would I not? So when I say exercise the option, I say that I will go in for the buy option.
So, sir, it's advisable to buy it.
Absolutely correct. So in S1, it will be advisable to purchase because the strike price which we had agreed on at initiation is 100 rupees. And currently the asset is trading at 150. So that way I get a right to purchase the asset at a below market price, isn't it? Because our price is 100, which is below the current market price of 150. So here you will definitely exercise. That way you can purchase the asset for 50 rupees cheaper than the market. So in S1, yes, the call option will be exercised. In S2, it doesn't make sense exercising the option because if the market is willing to sell the asset at 50, why should I exercise the option and purchase the same asset at 100 when I'm getting it at 50 in the open market? So in S2, I will not exercise. So that way, no exercise happens here. And this is how
Sir, I have a doubt.
yes.
Sir, in scenario one, why the party B will be will sell the the security for less than the market price?
Because that's an agreement, right? So what we have done, so imagine this is small t equal to 0. So on t equal to 0, we have signed on a piece of legal agreement which states that me as party A, I'm purchasing an option from B. That is, it's a call option which I have purchased from them, and these are the agreed terms. So that way, if you go back to the definition, I become the party option buyer, so I have the right but no obligation. But for party B, since they have sold the option, they only have an obligation. So according to the agreement, they will have to transact only at 100 and no at no other price, and that's why they have to sell me at 100 at scenario 1.
Okay, sir. Thank you.
So that way, I mean, the behavior of a call option would work. So that's why we say call is a right to buy, and this is an example supporting that. So any questions on this? Okay. So similarly, you can purchase a put option as well. So imagine that I am holding the asset today. So rather than purchasing the asset, let's say I already hold the asset X, and I want to sell the asset, but not immediately. I want to sell it in 1 month time. So what I could do is I could purchase a put option from someone, and we decide on a certain K. So K is also technically called as the strike price for the option. So I would want to freeze on a value of K today, and we will do the transaction accordingly. So behavior would be similar. So I would take two scenarios where the stock price might end up, and this is just for demonstration purpose because we don't know where the stock price will be. So I have just taken two levels above and below the strike. It could be anywhere else as well. But finally, we'll apply what we call as a payoff condition. So we'll talk a bit about payoffs as well. Yeah, and for options, you can have any kind of underlying which you want. If it's exchange, then yes, I mean it's a standardized contract. So that way you have to basically follow what the exchange tells you. But otherwise, if it's a OTC contract, you can design the contract the way you like, and you can have any kind of underlying as a part of the transaction. So that is acceptable as long as you have a willing counterparty to sign on the piece of paper with you. Also, those of you who are planning for any PhD or higher studies, and options happens to be a good area of research. So a lot of things have already happened in options, but those of you who would want to pursue something further, I think you can definitely consider options as one of the areas to do things or maybe do your research. So maybe this could be a good time to introduce the payoff condition. So is everyone familiar with what do we mean by an option payoff? So is everyone familiar with what is the payoff for a call and what is the payoff for a put option?
No, sir.
Okay. So payoff is something which decides what would be the value. So I won't say exactly value, but how much will that option generate? And let's take plain vanilla European options. So, or maybe, and is everyone familiar with European and American options? So, so we have two categories primarily. We have a European and American one. So is the bifurcation between them clear? So would anyone like to try?
So can I try?
Yes, please.
So for a European option and the American, the difference is between your ability to execute your right. So for a European option, you can only execute it once, that is at expiry. Whereas for an American option, you can execute it at any time you want.
Correct. Very good. So that is the main difference. So exercise for a European, exercise only at maturity. Whereas for American, the option can be exercised at any time from purchase up to maturity. So that is how you bifurcate between European and American options. So it only decides, it's decided on the time to exercise for the option. So in India, do we have European or American options?
European, sir.
Correct. Good. So on the NSE, we only have European options. We have call Europeans and put Europeans. Now, everything else being equal, assuming the same asset, the same time to expiry, which one would be cheaper than the other. So I have the same underline.
Sir, I guess the European would be cheaper.
Correct. Yes, it has to be cheaper because American option gives you flexibility. So whenever there's flexibility, naturally the cost will also increase. So if everything else is equal, European options are expected to be cheaper than American ones. Now, since we know the idea of European and American, let's say we have a plain vanilla option, a plain vanilla European option, and I want to write payoff conditions. So I have a call and a put. So I'll write an equation here. So a few students will be familiar with this, those who have studied options already. So this is what we call as a payoff condition. So payoff condition basically decides how much will the option generate if it is exercised. So that way, I mean, we can relate this call payoff with the earlier example, which we had seen. So we had compared 150, which was ST, versus K of 100. And then we had decided whether it was beneficial for me to exercise. So again, if I use these same numbers and if I use this equation, ST minus K, and if I write it here, so in my scenario 1, my C1 will be max of ST minus K or 0. And whereas in scenario 2, let's call it as C2, it will be max of ST minus K or 0. So as a result of this, I'll be taking out for C1 max of 50 or 0, which will be 50, and max of minus 50 or 0, which will be 0. That's why you say that exercising in scenario 1 is optimum, and scenario 2, we let the option expire worthless. So that's how I can relate the payoff conditions with what we have discussed earlier. So any questions on this?
So you have written K minus ST in scenario 2. But here you have written 50 minus 100.
Yeah, because in scenario 2, my ST is 50, right?
But in the equation, I guess on the second page, you have written K minus ST.
This is a put option.
Okay.
So you can ignore this for now. Focus only on the first option because we are talking of a call option.
Okay, sir. Okay.
Yeah. So I'm using just max of ST minus K. I'm not using K minus ST at the moment. If it's a put, that is, if I want to write to sell, then I'll use the max of K minus ST bit and then do the calculation. But for this example, we have relied only on the call option because we have the right to buy. So, to determine or to understand how much is an option generating in case it is exercised, we apply what we call as these payoff conditions. So these are something which we are going to consistently apply going ahead as well. Then options can transact both. I mean, as I mentioned, on exchange as well as OTC. But so is everyone familiar with the difference between products which transact on exchanges and products which transact in the OTC market? Can you tell me a few features which are specific to exchanges and OTC? Anyone
Sir,
can
you
tell.
have liquidity, you have counterparty risk.
So I have liquidity. Okay. So
Counterparty
counterparty
risk.
risk would be higher or lower for exchanges?
It would be lower, sir. Actually, it would be non-existent because you have a clearing authority in the middle.
Okay, CCP, correct.
Yeah, you would also have standardized products on the exchange, whereas the OTC will have more tailor-made products.
Correct. Standardized, customized. Okay. Anything else?
Sir, I think in terms of regulation, exchange would be governed by SEBI, whereas for OTC, there's no intervention by SEBI as such.
Correct. So higher regulation, comparatively lower regulation. Correct. Anything else?
None that I can think of, sir.
Can I also say price efficiency or price discovery? Yeah. So whenever we say OTC and exchanges, these are the main points which differentiates these two avenues, because these two are basically the avenues wherever I can transact. So anyone has any questions on these points? Do you want me to run through any or all of them? So was something covered for both the classes about the difference between these two avenues?
Sir, it is covered for AFE, sir.
Okay, okay,
So not covered for IBF.
okay. So do you guys at least know the basic? I mean, so what the concept of exchanges and OTC, at least those brief things have been covered in your curriculum, is it for the IB class?
Oh, now it's working. So could you explain CCP?
Yes, yes, of course. So I'll do that. But other points, do they look okay? I mean, liquidity, standardization, higher regulation, and price discovery. So otherwise, we can discuss everything quickly, serially. Or let's do that. Maybe let's do the whole thing so that those of you who have not studied this will not find it difficult to understand. So talking of exchanges, and then we can just contrast that along the way with OTC. So liquidity so maybe I would like to start with point number 3, which is standardization, because that gives rise to liquidity and price discovery. So starting with point 3, standardization. So if you go to any exchange, there will be a certain standardized way in which a certain contract has been designed. So if you go to even NSE's website and if you open the page on options contract or even futures contract, you'll find that contracts have been specifically defined by the exchange. So they say that this should be the strike price, this should be the term to maturity, this is the lot size, etc. So all the terms have been defined by the exchange, and market participants are expected to use them or follow them for their trading purposes. So that way, standardization or uniformity, that is unique to exchanges. But for OTC, that standardization doesn't exist. You can customize the contract in any way you like. That's the advantage as well. So that way, if you have a unique or a specific requirement, you can design the contract and work in the OTC space. So customization is something which you observe for OTC. Now, as a next step to standardization is liquidity. Now, something which is standardized or which is more uniform has a comparatively higher liquidity. Why I say a higher liquidity? Because this is a product which is uniform, and that way the market knows that these products are available for transacting purposes, be it for trading or for risk management purposes. So that way, the number of market participants is higher whenever your liquidity. So since it is standardized, the number of buyers and sellers is higher, which pushes the liquidity higher. And it's always good to have a liquid market, because whenever the liquidity is high, there is always better price discovery. So if the price discovery is better, you have an efficient price for a certain asset. So that way, I would say 3, 1, and 5 are interrelated. Once you have standardization, you have better liquidity. And once you have better liquidity, that is more numbers of buyers and sellers who are transacting on the same contract, you'll have a far better price discovery for that contract, which is an advantage, because it's always good to have a liquid market. Then point number 4, higher regulation. So exchanges are heavily regulated by the regulator. So in India, we have SEBI. In the United States, we have the SEC, which regulate whatever things happen on the exchange. And that way, exchange has to abide by every single rule and guideline which the market regulator has specified. Then talking of CCPs, which we call as central counterparties. So CCPs are there to reduce a specific type of risk. So those of you who have studied CCPs, which is the risk which a central counterparty reduces? So
So
we have
risk of default.
correct. So can I generalize that as a credit risk?
Yes, sir, credit risk.
Correct. So CCPs, or what we call as central counterparties, these are there to reduce the credit risk which is embedded in transactions. And the idea of having a CCP is to improve market confidence. That is, you have a certain party which is there to guarantee that a certain transaction happens smoothly. So for example, let's say this is my CCP, let's say this is the exchange, and we have two parties, A and B, which want to trade. So let's say they take path 1, whereby they transact with each other directly. So let's say this is my path 1, and let's take this combination as path 2. So A and B, small a and small b combined together is my path 2. Imagine. So focusing on path 1. So let's say there are two parties A and B which wish to transact, and let's say the CCP doesn't exist. So that way A and B have to transact with each other directly. That is, the entire clearing and settlement of the transaction is done by A and B. So any kind of potential counterparty default which is to happen, that is something which will be the onus of the counterparties entering into the trade. So this is also what we call as a bilaterally cleared transaction. So path 1 is a bilateral clearing and settlement because there are just two parties which are involved in the transaction. Now here the problem is either of the party may default. So they need to have certain measures which they can use for mitigating this potential credit risk which is there in the transaction. So I'm not saying that they will definitely default, but there is always a probability that if things go wrong, one of them might default for a variety of reasons, but that risk of default always exists. So in a bilaterally clear transaction, that is path 1, one has to manage credit risk by themselves. So various means, maybe frequent exchange of collateral, or maybe having an insurance firm step in case of default, etc. So that way you can have those kind of enhancements which need to be applied. Now let's contrast this with a CCP. So CCP is something which an exchange provides. So take any exchange, NSE, BSE, or any other global exchange as well. That exchange provides a service which we call as a central clearinghouse or a central counterparty. That means every transaction which happens through the exchange passes through the CCP. So we take the same trade between A and B, but now they don't trade directly. So in path 2, which we have shown here above, which we have bifurcated into small a and small b, that means CCP is acting as a middleman which will interact with A and B. So that way A will see CCP as the counterparty, B also sees CCP as the counterparty. So effectively, it's a buyer to every seller and it's a seller to every buyer. Advantage of CCP is that they are going to help in elimination of credit risk to a considerable extent. I won't generally it is 100%, but again, even CCP is a private institution, so they can default as well. But possibility of CCP defaulting is remote, so that's why I say generally the credit risk will be mitigated close to 100%. So that way, the same transaction will happen between A and B. However, now the onus of credit risk management, that is the daily clearing and the final settlement of the transaction, will be the onus of the CCP. So that way, CCP will break this transaction into two sections, A and B, and it will manage the credit risk accordingly. And that is how a presence of CCP will ensure that your risk of clearing and settlement gets eliminated, and that improves market confidence. And this is what an exchange facilitates. So is the idea okay? Yes, someone has raised the hand. Yes, Mir, please.
Sir, in case of traded via exchange, is there mark-to-market mechanism in which the transactions are squared off at the end of day to settle the price differences?
For futures, yes, a daily exchange is required. But for options, generally the option seller is expected to maintain a certain margin. For option buyer, they don't have to do anything because option buyer is just paying a premium, and that's like an upfront cost. But for futures, yes, there is a daily MTM. So any more questions on mechanism for CCP? Okay. So if you take parts A and B, so there is a process which, or there is a concept which we apply whenever you break up a larger trade into these two parts. So whenever you have a CCP and you say that you're dividing this bigger trade into two parts, A and B. So what is that concept called? So what exactly is CCP doing in this case? There is a technical name which we give to that. So those of you who might have read about CCPs will be aware of that terminology.
Sir, is it market making?
Not really, because CCP is
Clearing
not
house
really.
is there, and
Sorry.
no, sir.
Okay.
I think it's a clearing house which is in the.
So clearing and settlement, that is one, yes.
Yes, sir, this is the.
But a technical name given to that is what we call as novation. So whenever a CCP is breaking this trade, this larger trade one into two parts. Now, by the way, trade one and trade two are equivalent to each other. Only thing is we have a CCP in between. So breaking up the trade into parts A and B is what we call as novation of a trade. Why novation? Because this is like creation of something new, right? And we are taking this larger trade and we are divided into two new parts, A and B. So the technical name given to that is novation. And presence of CCP will greatly have an influence in enhancing market confidence, because when you know someone is taking care of the credit risk for you, you're always much more comfortable to trade. So exchanges have that advantage. They will provide clearing and settlement of services. Now for OTC, CCPs may or may not exist. So that's why I've written a Y/N. So a few transactions might be done on a CCP even for the OTC market, but majority of them are still bilaterally cleared. Because the thing is, OTC transactions can be customized in any way they like. And for a CCP to provide their clearing and settlement service, they generally look for certain standardized product which they are clear and settled. So a few examples of CCPs for the OTC market is they provide services for plain vanilla interest rate swaps, or they provide clearing and settlement for single name standardized CDS contracts as well. But other customized ones are something which still have to be settled via uh, bilateral transactions or bilateral clearing and settlement. But standardized ones, yes, there are organizations like LCH or maybe even Euroclear, etc., which are there to provide OTC or provide CCP services for the OTC. And gradually you'll see that there's an increasing push towards OTC. Sorry, not towards OTC, gradual push towards moving things onto a CCP, because everyone knows that credit risk is something which anyone will be exposed to. So people want to ensure that they have some way of mitigating that risk, and CCP happens to be a very effective way of doing things. So this is a brief about central counterparties. So any questions on this? Okay. Okay. So now is everyone clear with the difference between an exchange and a OTC? So people from IB class, you're seeing this for the first time. So that way, any questions on this further? Okay. So now, yeah, so I mean, there's still space here, so I'll just stay on this screen. Now, options will come in both varieties, plain vanilla or structured or exotic varieties. So for our discussions in this subject, we'll stick to the plain vanilla ones. And of course, the volume for plain vanilla contracts is far bigger as compared to structured or exotic varieties. So plain vanilla, European or American options, either of them, and they have ample amount of liquidity. So market participants generally prefer using them. Then for any option, we require a few set of inputs, which are listed here. So if I say V is my option price, then my option price will be a function of these 5 parameters. So spot rate of the underlying, the strike rate, interest rates, volatility, and time to expiry or time to maturity. So once you provide these 5 inputs, you can price any plain vanilla option. If it's a slightly exotic option, you may require some additional parameters. Maybe something like a barrier option would require input of a barrier price as well. But otherwise, these 5 parameters will primarily help you price any vanilla option.
What's a plain vanilla option?
So a plain vanilla option is something which you'll commonly observe in the market. So something which you have discussed in our example. So something which we say that following a simple payoff, max of ST minus K or K minus ST. Now, these type of options are plain vanilla options because these are the most basic form of options and they provide highest liquidity because maximum number of market participants prefer using them. So these are what you call as the plain vanilla ones. Structured varieties or exotic ones are where you have certain additional conditions which are applied on this payoff. So you may not have a simple payoff for exotic. You may have something which will be a combination of payoffs. So that is what we call as an exotic option. So we'll stick to the plain vanilla varieties. So most of our computations would work fine with these two payoffs. Also, a few popular models for pricing of options. We have a binomial and a Black-Scholes model. So we'll be starting with the binomial models today because this is a discrete time model, and understanding this model is comparatively easier as compared to Black-Scholes. So once we have the basic idea of these things, these concepts can be related to Black-Scholes as well. So we'll try and start with our discussion. We'll see if we can complete binomials today. If not, there will be some spillover which we'll complete on Monday. But I would like to start with the discrete varieties first because just jumping to continuous doesn't make sense. Then volatility is an important parameter which is required for pricing of options. So that is also one parameter which I have mentioned here. So point D. So volatility will play an important role in deciding how your option price is moving as well. So there are different measures of volatility which can be used as well. So you have an intrinsic volatility, historic, comparables as well. So we'll talk a bit about volatilities along the way. But for now, imagine that volatility is one important parameter which we'll use in our pricing. Then for any option, so option price is a combination. So it's a combination of intrinsic value and time value. So those of you who have studied options earlier, can you throw some light on what these terms mean? So my option price is a combination. It is IV plus TV. So would someone like to try? So maybe someone from financial economics who might have discussed this earlier as a part of your other subject.
Sir, intrinsic value is the value at which we lock the price, I think. And
that is the strike price actually.
yes, sir, that is, and the value price that, and some is the expiry price, sir, which is I think the intrinsic value.
So yes, those two components are there, but can you relate those components and then relate it to the intrinsic value? So yes, you're right. I mean, that is required, those two, but how do you use them? So can you try to combine them?
So actually, Ayush has raised the hand. He can try. Ayush.
Okay, sorry, I did not see your hand. Yeah, please go ahead.
Sir, basically intrinsic value, if I'm not wrong, depends on how much like the options value is in general. Like it may may be different for one stock and then it might be different for another. And as far as the time value is concerned, then we can just have an example that if that particular option is of say Tata Motors March end, then as compared to Tata Motors April end. So obviously, since time value in April is more, so it will be its price will be different from that of
Correct.
March series.
Correct. Okay, good. Yeah, so let me just elaborate that on a bit. So one simple way of looking at intrinsic value is nothing but your payoff. So max of ST minus K or K minus ST is what you call as the intrinsic value for the option. So this is simple to calculate. You just apply the payoff condition and you see what is the IV. Now, time value component, this has to do, so as one of you rightly said, I think it was, Ayush rightly said. So time value is associated with your time to expiry for the option or time to maturity for the option. So generally, longer the time to maturity, the higher would be the time value. This is because options as a product by itself is based on how exactly the movement in the underlying is expected to happen in the near future. And if the underlying moves in a certain way, that option may end up in the money or it won't. So that way, I mean, you need to allocate. So what you're trying to assess through the time value is if you can have certain value which is associated with the time which the underlying has to move in a certain direction. So as he rightly gave examples, we have option which is ending on March end and maybe an option which expires on April end. So one which is ending on March end has a lower time to maturity. So that way the underlying has lower or a lesser time in order to move in a certain direction. Whereas if we compare that with April, it still has one additional month. So that way it's a 2-month option. So the time value for the 2-month option is expected to be higher because that way your underlying has more time to move around so that your option prices can also move accordingly. So that way, generally, longer your time to expiry, the higher is your time value, and vice versa. So always remember, your option price will be a combination of these two, IV plus TV, or intrinsic value plus time value. Then the option payoffs are non-linear in nature. So, so simple linear products can be a forward contract. So if I say it's a linear product like a forward, and let's say the MTM for the forward contract comes out to be X dollars. Then if it is X dollars for, and let's say there are two parties, A and B, they have entered into a simple forward contract. So if the MTM for A is X dollars, then the MTM for B will be minus X dollars. So just the other way around. But for options, that's not really the case, because options work slightly differently. There you have a certain premium which gets paid by one of the counterparties, and then you try and relate that with the payoff which gets generated. So that way, it's not exactly very similar to what you observe for forwards. So other examples of linear products are futures, you have swaps, you have forward rate agreements, etc. But options are non-linear, and also volatility plays a key role in making the option behave non-linearly, because volatility by its very nature is going to have an impact on the option price, and that impact will make the option payoff further non-linear in nature. So that way it will be hard to have a simple equation like a forward. So if I have a X dollar here, the other party has an MTM of minus X, that is slightly difficult to correlate for an option, because for option you always try to understand from the premium and from the final payoff conditions. Then options trade in lot sizes. So is everyone familiar with lot size? So something which we study for futures as well.
Yes, sir.
Okay. So lot size basically defines what is the number of underlyings for every option contract. Then the concept of moneyness of options, that it is ATM, ITM, and OTM, which is at the money, in the money, and out of the money. So maybe let's take a simple example. So let's say I have a call option, and let's say S is the stock and K is the strike price. Then writing it simply, let's say I have an ITM, I have an ATM, and I have an OTM. And if I had to write what would be the situation for this call option in these three scenarios. So I will be in ITM if S is greater than K. I will be at ATM if S is equal to K. And I'll be an OTM if S is less than K. All that I have done is I have simply applied the payoff condition here. And then I've decided how should I bifurcate the option. In the money implies that we are making money on the option. That is, the payoff is being positive for us. So that's why I write this as S greater than K. At the money, it's exactly tallying with or exactly matching with the strike price. So S is equal to K. Whereas out of the money is when the option is not really generating a positive payoff for me. So that's why S less than K. So this is also technically what you call as moneyness for options. So many times people will talk about moneyness. So when they refer to moneyness, they are essentially talking about the same concept. Also, wall surface or wall smile. So something which we'll cover in our subsequent sessions. So wall smile or wall surface is something which is used to analyze the overall volatility which is being fetched from traded option prices, as well as something which is model driven as well. So we'll talk a bit about wall smiles and wall. So we won't spend too much time on wall surfaces, because surface is slightly complex to understand, but smiles are comparatively straightforward. So we'll discuss wall smiles at a later point in time once we have discussed a few more things on options. So request you to hold on till then. Similarly, option Greeks. So Greeks are like risk measurement parameters which you use with options, because for every asset you look, there is a certain risk which is associated, and we need some or the other way to manage that risk. So to manage that risk, we have something which we call as Greeks. So things like delta, gamma, theta, etc. So we'll talk a bit about Greeks along the way as well. So those Greek parameters will be used for quantifying how much amount of risk is being carried on your options book. Also, if you look at options from a trading perspective, one has to be very careful about it, because options by themselves are risky products. And unless you are very confident about a certain strategy, and do not get into options. So in case you wish to transact options, and get some feel of the market first before you actually start investing hard cash there, because one can quickly lose or make money in options. So accordingly, be careful. So if you haven't invested on your personal fronts, I would suggest that start with plain equity. Don't go in for options. But those of you who are confident, you can definitely start transacting options. And maybe a good idea could be start with only buying options first, because until you are confident, once you are confident, you may start selling options. Honestly, it's only the option sellers who make money in the long term. But selling options also requires a certain skill and experience, something which will build over a period of time. And for that, you need to have that risk appetite. So if you fit that bill, then yes, I mean you might want to start selling options at a certain point in time. So just advice. So even I have burned my hands in options earlier. So that way, I've learned from experience. So that way, hopefully, you should not repeat the same thing which I did. So just a suggestion.
So why is it that in long term only sellers make money in options?
Because generally, what happens is sellers are inherently risk takers, and the market will reward people who are risk takers, because that's how the market functions or any asset functions. Like those who are taking risk should expect a commensurate return. Now, why I say the long term? Because it's not every trade which a seller makes where they'll make money. They will lose money, and on a certain position, they'll lose money big time. So maybe out of every 10 transactions which a seller makes, on 8 of them, they'll make a loss. But maybe on a couple of transactions which work in their favor, they'll make a lot of payoff, or a large positive payoff, which will make up for all of those 8 losses which they have already made. So in the long term, generally, one who takes a higher amount of risk will be compensated with a higher return. So I'm not saying option buyer will not be compensated, but the quantum of compensation is expected to be lower, because it's always a risk and return thing which has to be seen.
Right, sir.
Okay. So any questions on these things which we have discussed up till now?
Excuse me, sir.
Yes.
Could you please explain an example of non-linearity?
The non-linear point, is it?
Yeah, just an example.
Okay. So a non-linear point could be a place whereby and you have so for basically, I mean, any option, firstly, it's non-linear in nature, because uh, so firstly, let's understand linearity, because that will help you contrast with the non-linear bits. So when you say a linear product, that means your payoffs are matching. So, or maybe the MTM you can exactly match. So that way, if I have a simple forward contract whereby A and B have entered into a forward contract, and let's say I'm calculating the fair value or MTM of the forward contract today, and let's say from A's perspective, that MTM comes out to be X dollars. Then from B's perspective, I can say that the MTM on this transaction is minus X dollars. So it's a simple transaction because it is linear in nature. But for options, it is slightly different, because for options, the technique of or the way in which that contract happens is different. That is, we exchange a premium payment at the outset, and then we have to see, depending on the option payoff, or what the profitability for that position is. So, and again, that profitability is something which is driven by the kind of volatility which you observe in options. So because of these 2 points, both, I mean, the nature of the option contract by design, and second is option volatility, that introduces non-linearity into the way in which your options positions are going to move. And that's why we say options are non-linear products. Any options or option-like products are non-linear in nature.
Okay.
So have you guys covered options on bonds as well? Are you guys comfortable with call and put options which are written on bonds? So was that covered as a part of your fixed income securities or maybe fixed income market?
No, sir, we did not cover that part.
Okay, okay. So we'll talk about it later. So when we talk of interest rate options, we'll talk a bit about that as well. Okay. Also, is everyone familiar with put call parity?
No, sir.
Okay, okay. So was this covered for financial economics class, or it wasn't covered? Let me
Yes, sir.
just.
It has covered, but right now we are not actually reminding it us.
Okay, okay. All right, so let me just open see my whiteboard in here. Yeah. I'm just trying to switch to my whiteboard. Why is it not showing me my whiteboard? Let me just close the paintbrush and open it once again. Ah. So a fundamental relationship for options, what we call as a put call parity relationship. No arbitrage relationship, but very, very important. So I'll write one expression first and then I'll explain. So financial economics class, do you remember something like this which might have been discussed in your earlier subject?
Yes, sir.
Yes, sir.
Yes, sir.
Okay. So the terms for this, we have C and P are nothing but European call and put options. S is the underlying stock. T is the time to maturity. R is the interest rate. And K is the strike price. And we'll assume plain vanilla European options. So these are the terminologies, and these are what these things mean. And this is also what you call as a fiduciary call portfolio, and this is a protective put portfolio. So you don't have to remember the names right now. We can call simply this thing as portfolio A, and we can call this as portfolio B. So what we do is portfolio A, you can imagine, is a combination of a call option plus a discounted value of, so I'll look at K slightly differently. So here I will look at K as a face value for a zero coupon bond with a maturity of capital T. So that way, if I write K into e raised to minus RT, that means I'm simply taking the present value of this ZCB. So I'll take K as the face value for the zero coupon bond, and that K is exactly the same as the strike price for both the options. So both of these options have been struck on the same underlying S. Also, they have the same time to maturity capital T, and they have the same strike capital K. So this is my portfolio A. Portfolio B is the put option, and S is the underlying stock. So there is an equivalence between this relationship, and that's why we call this as a no arbitrage relationship. So to understand why these are equivalent, so let me just do a simple working. So would anyone like, from our financial economics class who have studied this, would you like to explain why we call this as a no arbitrage relationship? Or maybe what could be an approach which I can follow to demonstrate no arbitrage? So maybe you might have done some basic working to demonstrate why A and B are equivalent to each other. So was that discussed as a part of your earlier subject?
So can I try?
Yes, please.
So the basic underlying theory or assumption is that as the time to maturity arises, the difference between them becomes closer and closer.
Okay. But if you have to somehow prove that A and B are exactly equivalent portfolios, or the worth of these portfolios is exactly equal today, so any approach which might have been discussed earlier, or maybe something which you might have read earlier somewhere. Anyone?
So can I try?
Yes, please.
I don't have a mathematical explanation, but intuitively, if you're buying something at say 100 rupees, it means that somebody is selling it at 100 rupees, right? So that's the so a similar logic applies here also. If you're buying a call option at say 100 rupees, means somebody else is also selling that same option for 100, right? So that's why your call and your put prices will always be the same.
Okay.
And of course, if there is any difference in that, then that's an arbitrage opportunity.
Okay. All right. So let's do a simple working. So we can actually demonstrate that these are equivalent portfolios, and then we can say that this is a no arbitrage relationship because this equality exists. So let's do a simple working here. So let's say this is my portfolio A here. So I have a call option and I have the ZCB. I'm going to take two scenarios as well. Sorry, just to redraw the line. Draw a straight line. Okay. And let's say I have a total for this, or let's say total A. Then I have portfolio B, which is a put, stock, and total of B. This is B. I'll take two scenarios, ST less than K and ST greater than K, and we try and understand. So ST is the stock price at time capital T. It could be less than K or greater than K. Let's see how it impacts both of these portfolios. So now, for call and put, I'm going to simply try and use the payoff condition, which I have discussed earlier, which is ST minus K or K minus ST. So for a call, it is ST minus K. So if ST is lower than K, this is expected to be 0. And for ST greater than K, this will be ST minus K. Simply applying max of ST minus K or 0. Now for a ZCB, it doesn't matter, right? Now ZCB doesn't have to bother where the stock price is, because there is no impact of stock price on the zero coupon bond. With passage of time and at capital T, ZCB will anyways expire or anyways mature to its face value. So earlier we had taken the discounted value to present value, but now with the passage of time, there's no discounting. At maturity, it will be equal to face value. So if I take the total, it will be 0 plus K, which is K, and ST minus K plus K is ST. So this is my portfolio A position. Now let's see how portfolio B gets impacted in similar scenarios. Now if I apply a payoff condition for the put option, then if ST is less than K, I again go back to my payoff condition, K minus ST or 0, and accordingly I write. So since this is favorable for me, I will write this as K minus ST. Now if ST breaches K, then naturally I don't really exercise the put option because it is not beneficial for me. So this will be 0. Again, for a stock, it doesn't have to, stock price is nothing but what you realize or what is realized at expiry. So we have ST and we have a ST. So no matter which scenario, stock price will always reach ST. So again, if I sum them up together, I have a K and I have a 0 plus ST as ST. So that's how you see that the total of portfolio A and the total of portfolio B are exactly equal to each other. And that's why we say that portfolios A and B are equivalent. So does this look okay? So that's why this is a no arbitrage relationship. Why no arbitrage? So firstly, is everyone familiar with the concept of what is arbitrage?
Yes, sir.
Okay, so what would be a very simple definition of arbitrage? Anyone?
Exploiting the
Making
price
the
difference.
Sorry?
Exploiting the price difference.
Okay, something even simpler. It's generating a riskless profit. Because without taking on any additional quantum of risk, you're able to generate a profit. So that's what we call as a simple layman definition of arbitrage. So now, since A and B are equivalent, can I also say that if they're equivalent, if I am entering into option contract today, or maybe if I see the options market, and if I try to solve a simple put call parity, these two sides should identically cost me the same. So if I combine call with a ZCB and a put with a stock, can I say that the cost for A and the cost for B today, or the worth of these portfolios today, should exactly be the same? So would that be a correct way of representing it?
I guess at the time of expiry, it is.
So if it is the same at time to expiry, then so if it's giving me a same payoff, or if it's helping me reach a same value at maturity, it should cost the same thing today, right? Because take any other asset. So if there are two assets, and if those assets are giving me the exact same value at maturity, they should cost the same today. Simple time value of money, isn't it? So can I apply it for put call parity also? So if I am reaching the same portfolio value at time capital T, I can safely say that these two portfolios should be equivalent today as well. It's just the passage of time, isn't it? So does everyone concur? So ignore this, I mean, ignore put call parity. Take any two assets. If you know that those two assets are going to yield you the same value at time capital T, they should cost you the same today. It's a TVM calculation. So the same thing applies for put call as well. If these two portfolios are yielding the same values in both the scenarios at time capital T, they should essentially cost you the same today. And that's why we say it's a no arbitrage relationship. So any kind of imbalance which happens. So if this equality is violated, then that generates arbitrage opportunities. So was an example of arbitraging covered in your earlier class? So in case there is an arbitrage opportunity, how do you lock it? So what was that covered? So in case of an imbalance, what is to be done? So did you go through those steps?
So in a very uh, short way, we can say that the A formula was used. The A part of formula was used and then determined uh, against the stock price, and then we checked if it is undervalued, overvalued, and
Correct.
thereby whether it should be shorted or long.
Correct. So basically, you must have followed the buy low and sell high logic there.
Yes, sir.
Correct. So did you also try some simple demonstration on that, or maybe was that discussed as well? So in case you see an arbitrage opportunity, how do you exploit that? So yes, buy low and sell high, yes, but do you guys have full clarity as to how that strategy would work? So was that also covered, and was that covered for the IB class also?
No, sir.
Okay, okay. All right. So we are at 12:35, 12:38. So should we take a break for like 5 minutes and come back? And then we'll do a simple working on how you can exploit a put call parity, because these are fundamental relationships. Once you're familiar with these things, understanding other things would be comparatively easy, or it would be straightforward. So we'll do one simple working to see if an arbitrage opportunity exists. So how do you do the buy low and sell high thing, and how it actually helps you lock in a certain profit. So that is something which we'll try. So can we take a break for 5 minutes and then resume?
Yes,
Yes,
sir.
sir.
Yeah. Okay. Can we resume? Is everyone back?
Yes, sir, we're back.
Okay. So let's do a simple demo so that we know how exactly an arbitrage opportunity gets spotted, as well as if you have to capitalize on that, how do you do that? So that way, I mean, this might have been covered to a certain extent in your FE class, but for maybe the IB class, this could be new. So it would be helpful to quickly run through once. Let's say I have a certain set of market information which is given to me. So I have a certain call price. So let's say call is something maybe let's say 4.5. Let's say the put is worth something like 3.8. Time to maturity is maybe 3 months or 90 days. Let's say the stock price today is 75. Let's say the strike price is also 75. Let's say the rate is 5%. So these are a few things which are given to us. So based on this, we are supposed to see if there is an arbitrage opportunity which exists, and if it does, then how do you capitalize on that? So if I plug it into my put call parity, and if I have to understand which portfolio to buy and which to sell, so I write the put call parity, which is call plus discounted value. Percent into 3 months. 3.2. So can someone maybe open up an Excel or maybe a calculator and help me calculate the value on the left hand side? I'll write the one on the right, it's easy. So I just have to see if the what equality it holds. So just the question mark on top. So this will be 78.8. So could someone help me with this right hand side, please? Because we need to compare these two. So this is my portfolio A and this is my portfolio B. Yeah, so is everyone familiar with the exponent notation? And have you guys used exponent before in Excel? So I'll also do the calculation in parallel. Okay, so there's someone has got 80.44. 80 appears to be slightly higher because we are discounting 75, right? Let me just try that as well. 80 appears to be slightly higher. I'll also just check. Discounting 75. E raised to minus RT, so minus 5% into 1/4. 5% into 0.25 into 75. So I'm getting something like, yeah, this is 4.5. So I'm getting something like 78.56. Are you guys getting that as well? So this is the exponent bit. So those of you who have not used use exponents earlier. So have you used that E equal to operator? So equal to EXP operators. Have you used that in Excel before? Because that is something which you have to frequently use later on as well. Yeah, 78.56. Thank you very much. Yes. So that tallies. So good. So that way, we know that there is an imbalance between this equation. So one side is lower, other side is higher. So I can put this relation. So my left hand side is lower than the right hand side. And now we want to lock in an arbitrage opportunity. So when I say I'm locking in an arbitrage opportunity, that implies that I will be doing a certain set of actions today, which will guarantee a certain profit at a certain point of time, which is my time to expiry. So at the 3 month time point, I'll be able to earn that profit for something which I have done today because of this arbitrage opportunity. So for this, you always buy low and you sell high. So once you do these transactions today, you are going to lock in the arbitrage. So now, as a part of our activity, we are going to purchase portfolio A today, and we are going to sell portfolio B today, and that is all that we do. So at time to maturity, which is at time 3 months, we will observe that no matter what happens, that kind of profit is secured. So some payoff which we generate today, that is safe. That will be immune to anything which happens in the future. So should we try that? So should we try a simple working to demonstrate how that can be done? So was this covered? I mean, maybe up till this point, it might have been covered for the financial economics class. So in case, so what strategies you need to do today to lock in the profit? Was that covered as well? For our FE class. Okay. So a simple working for that, again, we are buying A and we are selling B. So we have our portfolio A and it was 78.56, right? So 78.56 and the other side was 78. So 78.56 and 78.8. So that way the difference between the two is the profit which you are trying to lock in. So something like 0.24. So 0.24 is what I call as the arbitrage profit, which I want to lock in. I want to lock in today because there is a difference between these two. 78.56 is the portfolio on the left-hand side, which is A. 78.8 is the portfolio on the right-hand side, which is B. Now I will be buying A and I'll be selling B. So let's see how that will work. So I'll just write portfolio A first. So I have a buy call. And I have a buy the ZCV. And on the other side, we have B, which we are going to short. So we have a sell put. And we are short selling the stock as well. So is everyone familiar with the concept of short selling a stock? So when you're taking a short stock position, what exactly do you do? So sell, you can also say, maybe I'll just replace sell by short, if that sounds better. So maybe let me write this in terms of our terminology, which we use very often, which is long and short. It means the same thing, but just trying to stay close to the convention. So long a call and long a ZCB. And short a put and short a stock. Short stock. So do I short a stock in a rising market or do I short it in a falling market?
So you short it in a falling market.
Correct. Very good. Yes. So just writing the values here. So I think this was 3.8, right? I had taken 3.8 earlier. This is 3.8. So I'm just plotting the cash flows quickly just to have this number for our calculations. And this was something which I calculated on Excel. That it was 74.06. Okay, and put was something like 4.5. Sorry, I put it the other way around. This was 4.5. This was 3.8. And the stock price was, we had taken off 75. And by combining these two, we had a total difference of 0.24. So I want to lock this thing today. So no matter what happens at 3 months, this should be secured. So that is what I'm trying to do. So let's say I am at the 3M point here. At 3 months point, I'll just erase the thing on the right hand side. Split it up into two parts to see how exactly it would work. So let's take two scenarios, simple ones. ST less than strike, ST greater than strike. And we'll see what happens for the two scenarios. So for A, so we'll take the position and then we'll see what the cash flow is. So can someone help me with what the cash flow would be for this scenario? So how much would be the cash flow for a long call and a long ZCB in a scenario ST less than K? Would anyone like to try? So in the meantime, I'll just write the below as well. So you have to simply apply the payoff condition for ST less than K and figure out value for CF. CF is the cash flow. Or maybe if you could explain me what actions happen, even that would also be fine. Even if we don't want to see it item-wise, even that activity which we do in this scenario should be okay. So for a scenario ST less than K, for portfolio A, what would happen and what do you expect should happen? So firstly, maybe just let's take a step back. So when I say a long call position, what exactly am I promising today? So can I say that a long call is a right to buy? So can I call this as a right to buy? Would that be okay?
Yes.
And if I have short the put, what would that mean?
It's a promise to sell, sir.
No, I have a short put, so I have sold them something.
Okay, so
we are selling the right to sell.
Just a thing, they are selling the right to sell. No. So it's like an obligation of me. I don't have a right. So
yeah, correct.
What do you think from an obligation perspective? So can I say that short put is an obligation to buy?
Yes, sir. It's an obligation for us if they exercise the option.
Exactly, correct. Because someone else is holding the option, so it is their right. So it is my obligation. So that's why I can say short is an obligation to buy. So now, in a scenario where ST is less than K, would it be beneficial for me to exercise the call option? So should I exercise call here, wherever stock price is less than the strike price? Think
No,
from
sir, you should
payoff
not.
condition. Correct. So in this first scenario, ST less than K, my call option will not be exercised because it doesn't make sense for me to exercise. If the stock price is lower than the strike price, if I simply go back to my payoff condition, accordingly, I will not exercise the call option. So the call expires worthless. But my zero coupon bond is anyways going to mature. It doesn't have to do anything with where the stock price is vis-a-vis the strike price. So in this, I will receive. So I'll write both the items, call and put. So call expires worthless. This is one. Whereas two, I receive the proceeds from the ZCB. Proceeds from maturity of the ZCB, which is 75 here. So it's a plus 75. Now, for second one, what would happen? So now, would it be beneficial for the counterparty to exercise the put option in this scenario, ST less than K? So I've sold the put option to someone. So in ST less than K, would they exercise the short put against me?
Yes, sir, they would.
Correct. Because it's beneficial for them. You can apply K minus ST condition and then C. So from their perspective, it is profitable for them. So they are going to exercise the put option. So if they exercise the put option, that is the right to sell for them. So that is an obligation to buy, because if they're selling, someone has to buy, right? So it's an obligation for me to purchase. So I have to, so in this, I can say put exercised and stock has to be purchased under the contract. So that way this will be a cash outflow for me. So it will be minus 75 because the transaction will happen at 75, which is my strike price. Okay. So yeah, again, now I have this short stock which I have purchased, right? So when the put gets exercised by my counterparty, I purchase the stock from them, and I still have a short stock position which has to be squared off, because a short stock means I have borrowed the stock from someone, so that has to be returned back. So the stock which I purchased as a part of this put option will be used to satisfy the short stock position. This will be squaring off the short, which is also what we call as just setting off my short stock position. So square of the short stock. Of course, this doesn't entail any cash flow because I'm simply taking the stock and I'm returning it to the rightful owner. So that's why plus 75 and minus 75 will yield me a final result of 0. So no impact in this scenario. Now let's try to do something similar for the other scenario as well. ST greater than K. So let's look from a portfolio A's perspective. So now if stock price is greater than K, how do you expect portfolio A would behave? So what would be the actions which will happen in this first box where stock price is greater than K? Again, you have to simply apply the payoff condition and think in those terms. So can I say that here the call will be exercised and the stock will be purchased?
Yes, sir.
Yeah. So call exercised and stock purchased or stock bought, whichever. And this will be a negative cash flow for me because it's a cash outflow, right? So it is minus 75. Again, ZCB, it has nothing to do with where the stock price is vis-a-vis the strike. So ZCB proceeds will be plus 75 again. Now for portfolio B, what would happen? And will the put be exercised or not?
No, sir.
Correct. So the put will not be exercised because it doesn't make sense for the counterparty to exercise the put. So the put expires worthless. So that way there's no cash flow on the put at all. However, there is still a short stock position which I have to satisfy. Now that is something which will get satisfied through the stock which I have purchased here, because my call was exercised and the stock was purchased. So I am already in possession of a unit of stock, and that stock will be used for squaring of the position. So the items to be written here is put expires worthless, and square off position or square off stock, short stock position. Again, no cash flow here, no cash flow here. So if I combine these two, I again get at 0. So that way we see that a certain action which we have done today on the left hand side. So by doing certain actions on portfolio A and B, we were able to secure this profit of 0.24. So no matter where the market ended in 3 months time, it was not of any concern to us. This profit was secured. So this is how an arbitrage opportunity can be locked in, and that's why we say that it's a no arbitrage relationship. Any kind of imbalance in that relationship should yield you a positive payoff, and this is also a riskless payoff, isn't it? Because we are looking at two portfolios which should ideally yield us the exact value or exact same value at expiry, but they aren't because there are mispricing in securities, and we are trying to capitalize on the mispricing through such kind of strategies. And this is what we call as arbitrage, because we are not really taking any additional risk. We are simply uh, using the mispricings which are there, and we are leveraging that in order to generate the profit. So that's how you can exploit an arbitrage opportunity. So you may have an algorithm which can continuously track arbitrage opportunities in the market as well. So you can do it in either Python or even a simple VBA as well. So that way you can continuously test if there are opportunities and you can take a trading action. But for these kind of things, it's always better that you have some kind of an algorithm to do it for you, so that let the machine take a quick decision as to what is to be done. Because manually it takes a long time to calculate arbitrage, and by that time those opportunities will vanish, because arbitrage opportunities provide a very small quantum of payoffs. So that way, in order to generate a large payoff, you need to have good volume of such opportunities. And these exist for a very short time, because mispricing in securities, if one of the market participant is able to spot, then it's just a matter of time before others also start transacting on the same opportunity, and it will quickly vanish. And once everyone targets that opportunity, the prices return to equilibrium levels, which will eliminate any kind of possibilities of arbitrage. So that way, any kind of good quality algorithms which you may be having, that is something which can be used to lock in and earn an arbitrage profit. Okay. So does this look okay? Okay. Yeah, so good. I mean, these things were all the building blocks which were expected. This is fine. Okay. So now we can actually discuss something specific to options pricing now. So let me just share another presentation. So now would be a good time to begin discussion on the binomial bits. So actually, we'll be going in for subsequent discussions on risk neutrality, no arbitrage, etc. But that is something which we'll have to cover tomorrow. We'll not be able to do it today. So tomorrow, I mean on Monday. Okay, so a few things which are specific to binomial option pricing. So firstly, a requirement for option pricing. So when you say you're having a good quality model for pricing an option or for calculating the fair value of an option, why do you really require it? I mean, why does one have to price options? What are the reasons behind it? So what are the applications whereby you can use these option pricings for actual consumption? Anyone? So you have all
Sir,
these
the three
sophisticated models.
applications you've got. So you've got the three applications: hedging, arbitrage, and speculation trading. That's why
Those are
these three would be
correct. So those are, I mean, those are market or categories of market participants. Yes. So that is something which is there for broader derivatives as well. But imagine that I'm using a Black-Scholes-Merton model, and that is giving me an option MTM on a daily basis. Sorry. So option MTM is being generated. So can you think of a few places whereby this option MTM will get used? So where will this number flow in? So I'll start. So just to give you an example, this can be to analyze my daily portfolio valuation. Any other areas which you can think of where option MTM will be useful? Because that will help us understand why we require option pricing. So we will study option pricing, but understanding the rationale is important. This could be one. Any other areas where you feel that the option MTM or the fair value of the option will be useful for me? Anyone? Not just an option, take any asset. So imagine that I have invested my money somewhere. Imagine I am a bank and I have invested my money in a certain asset, and I would want to know, or maybe I have a calculator to tell me this is the value of my asset today. So can you think of a few places where a bank might want to use this value, or where will be the downstream consumption of this MTM? So why take all the pain to do option pricing?
So the bank's risk function would also be interested in this, right? Just to know their
Okay,
position.
correct. So risk management. Okay. Anything else? Any other places where option pricing or option MTM is necessary? So can I also say regulatory reporting? Regulatory or MIS reporting? Next, can I also say capital requirements?
Please close for the day.
Sorry.
For the day.
Sorry, your voice is breaking. Could you repeat, please?
Sir, can we please close for the day?
Yeah, so maybe can I just complete this list and then maybe we can close?
Okay, sir.
Because there's still about 15 minutes, but at least let's stretch it till 1:15 and then we can stop. Any other areas which you can think of? We'll talk a bit about these things in our next class. So what are these? So another is your something like value at risk as well. It also gets used in stress testing or scenario analysis and even collateral exchange, exposure monitoring, etc. All right. So, and of course, we'll walk through this list in our next class when we meet. So that way, I mean, but good. I mean, we are able to cover specific things on options, something which will come handy for our discussions later on, because a few of you had studied options earlier. So for you, maybe a few things might have been a recap today, but for others who have not studied options up till now, and this is like a good start, because now we can discuss what is option pricing. Now, had we directly started with what is option pricing, it would have been difficult for everyone to understand. So that way our basic ground is done. So now we can build on top of that. So when we meet on Monday, we will start our discussion further on binomial option pricing. So we'll discuss some specific concepts which are required for that as well. So before we depart, allow me to take your attendance. Okay, so starting with the economics class. Akash Singh, Achal Jain,
Present, sir.
Ayush is present. Adesha Hathi, Tejas Akware, Ali is present. Anjali Garg, okay. Anmol Sen,
Present, sir.
Arishmita Deka, Avni Mishra,
Present, sir.
Ayushi Rotagi, Sarvesh Bagal,
Present, sir.
Bhavya Dang, Cherry Chabra,
Present, sir.
Dipansha Singh, Diksha Chauhan, Gaurav Kadam,
Present, sir.
Gaurav Datir, Himanshi Verma,
Present, sir.
Jaideep Seni,
Present, sir.
K. Ayushi,
Present, sir.
Riya Shukla, Kriti Marwa, Mansi Singhal,
Present, sir.
Man Simran Arora,
Present, sir.
Manvi Kukreja,
Yes, sir. Present.
Mihir is present. Muskan Garg,
Present, sir.
Namrata Gaur, Neil Dhar, Nikhil Agarwal,
Present, sir.
Prasoon Sharma, Pratik Maheshwari, Tyagi,
Present, sir.
Rahul Ghosh,
Present, sir.
Rahul Giri, Rahul Goswami, Rajadit Singh,
Present, sir.
Rashi Jain,
Present, sir.
Rishav Kothari, Roma Keshri,
Sir, present.
Sahaj Manoja, Samiksha Chopra, Sharanya Bhattacharji,
Present, sir.
Shubham Jain, Shubham Kumar,
Yes, sir. Present, sir.
Someshwar is present as well. Stuti Mehrotra,
Present, sir.
Sanika Thakur,
Present, sir.
Vinaya Pawar. So FE class is done. So in case you have
Sir,
FE,
please mark for Dipansha. My network is very weak.
okay, Dipancha Singh, right?
Yes, sir.
Yes, sir, for Akash Singh also.
Gosh. So FE class, in case you have any other commitment after this, you can leave. Your attendance is done. I'll just take the IB class attendance and we'll close. So I look forward to meeting all of you on Monday. So IB class requests you to stay back. We'll just complete your attendance in a couple of minutes and you guys can leave as well. Ayush Sharma,
Present, sir.
Alisha Gupta,
Present, sir.
Vidhi, Anant Jain,
Sir, Vidhi, present.
Anant Jain, Anish Dopeshwarkar, Anjali Sethi, Arshada Imam,
Present, sir.
Barkha Israni, Bhavya Patel. So there are two Bhavya Patels, is it? One is Bhavya Patel here and no, sorry, my apologies. It was Bhavya Dang. Sorry. Yeah, Bhavya Patel absent. Saloni Bhujbal,
Present, sir.
Chaitra Tirodkar,
Present, sir.
Devam Pandey,
Present, sir.
Diksha Kalra, Gauraja Nevatia, okay. Gayatri Narkhede,
Present, sir.
okay. Govind Mittal, Sawan Hake,
Present, sir.
Himanshi Veermani, Hindu, Chitra Saxena,
Present, sir.
Kanika Goyal, Kartik Pittal, Asro L, Lakshya Singhal, Mahi Rajawat, Mansi Gupta, Matangi Warrior is present.
Present, sir.
Yes, I'm active present. Yeah. Megha Parak,
Present, sir.
Nancy Ahlawat, Neha Jain, Pratishtha Pradhan is present. I recollect seeing the name. Rohan Bagai, Rohit Poddar,
Present, sir.
Samida Malik, Shivangi Semwan, Simrat Pahuja,
Present, sir.
okay. Srishti Verma,
Present, sir.
Tanu Goyal, Tarang Kadyan, Kalyani Todkari,
Present, sir.
Twinkle Karnawat, Vaishnavi Shrotriya, Vanishka Jain,
Present, sir.
Vibhor is present.
Yes, sir, present.
Vidushi Rana,
Present, sir. Sir, Himanshi is also present. She has written in the chat.
oh, okay. I'll mark her then, yeah. And Yash Mehra, all right, yeah. So I'll just mark Himanshi.
Sir, could you please mark Ayush from FE?
Yes.
Sir, could you please mark Kriti Marva, Mahi, and Kanika Goyal as well?
Kriti Marva.
We have written in the chat box.
Oh, okay. All right. Okay. All right, yeah, I'll mark these.
Sir,
These.
Ayushi Rodgi from FE.
Okay. All right.
Thank you, sir.
Thank you. So I look forward to meeting you on Monday, and we'll take our discussion ahead.
So on Monday the class is at evening, right?
Yes. So again, this Monday, I have some other commitment in the morning. So again, we'll have one evening class. So it will be like a 7 to 9 thing again.
Okay, sir.
Sorry, not 7 to 9. I think it's prior to that.
6:30 to 8:30.
6:30 to. Yeah. Correct.
Sir?
Yes.
So, sir, just an honest confrontation.
Mhm.
Sir, the class is very interesting, but sometimes we don't really know the concepts that the financial economics people are, acquainted with over
Correct.
the past 3 semesters.
Correct.
So it will be better if we just try to, thoda sa, kind of slow the pace of the class,
Sure.
because IBF is finding it thoda sa hard to cope with.
Okay. Yeah, that we can do. Yes. So that we can regulate. No problem.
Yeah, like also if there's any reading material that we can come prepared with for the class, also should be great.
Sure. So generally, John Hull happens to be a good reference. So that way, I'll anyways email it across. So that way, generally, you guys can start going through. And anyways, we'll discuss the basics in class. So maybe for every topic, we'll do a quick recap of a few things which are required, and then we'll build on top of that.
Yeah, that will be really helpful.
Yeah.
Also, sir, just for today, like we all of us have attended the class together at the GIP classroom.
Okay.
So, thoda sa there was a technological,
Okay.
yeah.
Okay.
So, could you please send over the PPT in case just today, so we
Yeah,
can just go
I'll
through it?
anyways be sharing the PPTs. So that way you don't have to note down the PPTs. I have to share the earlier one as well. So that also I'll do. So maybe, I mean, who is the CR? Can you maybe just
Yeah,
email me
Rohit
your...
Poddar. We are talking from his ID.
Okay. So maybe if you could email me, if you could send me your email, I'll send it across and then you guys can circulate it amongst the candidates.
Yeah, so the next lecture we'll at least be a little synced in.
Yes, no problem. So that anyways I'll share. So that PPTs you don't have to note down. Any other things which you find relevant, you are free to write along the way.
Right, sir.
Yeah.
Thank you.
All right. Thank you.
Sir, one more point. Sir,
Yes,
could you
Ayush.
please, educate us on how to execute an option in real life or maybe a future?
So you say execute, that is basically the actual trading bit, is it?
Yes, sir.
Okay. Yeah, I mean, we can talk about that. So how exactly do you trade an option? So generally, I'll tell you a few ideas. Of course, every strategy is something which will be specific to someone, but and everyone may not find it appealing. But generally, giving an idea as to how you can transact, that is something which you can discuss around the way.
Sure. Thank you, sir.
Yeah. Great. All right. So thank you very much, and all of you have a good weekend ahead. And I look forward to meeting you on Monday evening. Yeah. Thank you.
Sure,
Thank you, sir.
Yeah.
Thank you, sir.
Thank you. I'll just mark the remaining guys and then I'll log out.
Can you send your number so that
Yes.
email IDs for both the courses?
Okay. So if I send it to this email ID, MSCIBEF2020, that should suffice, is it?
There are two courses,
Correct.
like IBF and FE.
Okay. So for FE, could you ping me in the chat as well, your email one? So on that, I'll send.
Just need to be. So just a second.
Yeah.
I'll type in both the email IDs.
Sure. That will be helpful. So I'll just
Yes,
copy
sir.
that and keep it aside.
Yes, sir.
Okay. So MS. CIBF2020. Okay, so this is for the IB class, I understand.
Just a second.
Uh,
For IBF, we have sent it, and for FE, we have sent it.
Yes, yes, yeah. So once you send it, ping it for FE, and I'll note both of them. So basically, whatever email I send, I should mark both of these IDs, right? But will I
Yes, sir.
have access to them because this is some kind of a group, right? Will I be allowed
Yes,
to
sir.
write?
Sir, this is a group mail ID,
Okay,
so everyone will get the mail.
but
And you just,
I can write to the group, right? Or do I? So do I have access? So that I'll check. If I don't have access permissions, I'll get in touch with you.
sir, you can use the ID from which you logged in right now, like
Oh, okay,
FE.
okay. Ha, ha, ha. So
So
I
from GIP to GIP, you can send group email IDs.
understood, understood. Ha.
Yes, sir.
So I should not use my normal Gmail ID. Okay,
Yes, sir. That
understood.
will be convenient for everyone.
Exactly. And I think I'll have access on this GIP ID, but I won't have access on my personal Gmail ID then. Correct, correct. Okay, understood. So
So this is for FE.
yes, yes. So I'll make a note of both of them and I'll email it across tomorrow. So actually, I'm traveling in the afternoon. So so once I reach my destination, I'll just email it across. My laptop will be with me.
Okay, sir. Thank you, sir.
Yeah.
Thank
Thank
you,
you.
sir.
So have a good weekend and take care.
Yes, sir. Same to you, sir.
Bye bye.